welcome to this week's Echo45 Advisors Market and Economic Update. My name is James Sutton, Senior Relationship Manager with Echo45 Advisors, and I'm filling in for John Henderson this week. In this video, we'll discuss the debate around a soft landing for the economy and Fed policy. This is one of the biggest questions for investors right now, since hopes for a soft landing helped to drive the strong market gains we saw last year. So over the next few minutes, we'll define what this is and explore three key insights into this topic that will likely affect investors in 2024. First, what is a soft landing? This is a term that investors use that describes a situation where the Fed lowers inflation without causing a recession. Now, historically, this has been difficult to achieve because Fed rate hikes slow the economy. In the early 1980s, the Fed was forced to create a recession in order to fight rapidly rising inflation. Fears of a so-called hard landing is what drove a bear market in 2022 across stocks and bonds. However, in 2023, inflation improved dramatically, even as economic growth remained strong. This chart shows the level of job gains, which have continued to rise. Last year, about 2.7 million jobs were added despite fears of a recession. Second, improving inflation with a steady economy means the Fed can now consider cutting rates. Markets anticipate that the Fed could begin to do so by the middle of the year. This is where investors begin to disagree on the timing and size of these rate cuts, including whether they will begin in March or May, and whether there will be 75 basis points or 150 basis points in cuts or more. This is why it's important for all investors to keep questions in perspective. Whether or not rate cuts begin in March or May has little impact on the overall trajectory of the economy and markets. None of these trends change based on the debate that is happening among investors and in the news media every day. So this debate matters not because it affects the big picture, but because markets have already priced in so much. Much of last year's stock market gains were in anticipation of these events. This chart shows that valuations have risen as a result. Specifically, the price-to-earnings ratio for the S&P 500 has jumped back to 19.8x. If the economy does continue to grow and corporate profits improve, then these valuations would be justified. In the meantime, however, this means that debates over smaller differences in the overall trends could drive market swings. It's important in this context to not get caught up in the details and lose sight of the bigger picture. The probability of a soft landing increased last year, and both markets and the economy are in a much better place than investors and economists had anticipated just a year ago. We hope you found these insights helpful. If you'd like to discuss any of these topics in more detail, please don't hesitate to reach out to us. We look forward to speaking with you soon. Have a great week.